Hi everyone, here's Bolger here, the Chief Investment Officer at Viridian. Well, here we are at the back end of November, and who would have thought the performance that we would have seen in financial markets over the last couple of months. Our local equity market is up roughly around about 13% month to date, while global markets up a similar amount, with the S&P 500 up close to 12.5%. And we think about the performance of financial markets, particularly equity markets, through the course of 2020. It leads us back to thinking how we're positioning our portfolios throughout the course of 2020 and how we've been engaging with our clients in regards to those portfolio positions. And I've just got a couple of charts just to highlight the work that we've done in this area and the reason why we think it's really important in the context of managing a portfolio and positioning a portfolio that you've always got to be focusing on the opportunities that present. And these two charts really are just reflecting that in the context of our balanced investment portfolio and the asset allocation tilts that we've made across that portfolio in terms of growth assets versus defensive assets. And you can see here, this first chart here is just highlighting the over and underweight positions that we've held in growth and defensive assets relative to their neutral or strategic asset allocation framework. And the first point to note, really, if we look back, heading into this year, we certainly did have a growth bias across our portfolio. So we're overweight equities predominantly and underweight fixed income. And as we went through that first quarter, we made some pretty significant changes on the back of the global lockdown that we saw through COVID. And what really changed our view was the move by the US Federal Reserve back at the end of March to start buying treasuries, corporate debt and ETFs. And from our perspective, we felt that that was going to put a floor under financial markets. And ultimately, with the fiscal responses that we saw from governments around the world, Australia included, as well as further interest rate easing by central banks around the world, we felt that that was going to benefit financial assets and growth assets, particularly relative to defensive assets, namely bonds and treasuries. Now, we didn't know the timing of that. But what we did know was that we felt confident that through the course of the year, this was going to play out and was ultimately going to lead to a revaluation of equity assets. And as you can see through that chart, through the course of 2020, we've been selectively adding to our growth assets. It hasn't always been in equities. It hasn't always been in one particular asset class in that context. But by slightly adding to our growth assets through the course of this year, we've been able to continually add value to our portfolios, as well as, most importantly, earn back that lost value that we saw through the downturns of February and March particularly. And the second chart here is just highlighting that in the context of that value add that we can generate from having that active asset allocation, that active overlay that we bring to our portfolios. And you can see here, throughout the journey that we've been managing the portfolios, we've added just a little over 3.5% in our active asset allocation decisioning, our dynamic approach to managing the portfolios. And since the worst of the underperformance that we saw in March in terms of financial markets, a little over 1.3%. So the ability to be able to reposition the portfolios, to be able to provide that overlay on a continual basis and do it in a timely and efficient manner, in our view, has really been able to, as I said, deliver above performance and, as I said, get us back to where we were before the crisis hit in the early part of the year. The second point to note is that it's always important to remain one eye focused on the future. So despite the worst that we saw in terms of financial market performance and the economic lockdown that we saw through that first quarter, governments, central banks and communities have responded into how to best deal with the pandemic. Now, clearly, we're not out of the woods as it relates to COVID, and 2021 is going to continue to be a very challenging year. But as we sit here today, certainly on the information that we've got available to us, we think the outlook for growth assets is continuing to look positive, and we remain constructive on growth assets relative to having defensive assets within our portfolios. Important to note, we don't completely flip the portfolios and get out of defensive assets such as bonds and treasuries and the like. They do perform that buffer. But we think the strategy that we have going into 2021 and the ability for us to be able to manage that strategy on an ongoing basis has really added value to our portfolios and ultimately to our clients. As always, we look forward to speaking with you. If you have any queries or concerns about your portfolio, please feel free to reach out to any one of our advisors. And finally, we're doing a live webinar on the 15th of December, myself and joined by my colleague, Dominic Melchek, just to give you a snapshot and the overview of how we've seen 2020, how we've managed that from a portfolio standpoint, and some of our thoughts as it relates to our outlook for 2021. We hope you can join us for an interactive session, and as I said, we look forward and seeing you then again then. Thanks. Bye for now.